Michael Burry, the legendary investor known for his bold bets and for famously predicting the 2008 financial crisis, is back with a fresh set of stock picks. Through his hedge fund Scion Assets Management, Burry disclosed 13 positions, and 8 of them are brand new. That means that he found 8 stocks last quarter that he thinks should go up in price. And spoiler alert, I found a few of them to be extremely interesting. In this video, we're going to break down his latest portfolio, we will highlight the key changes, and take a closer look at those 8 new positions. This is already my 7th video in the Super Investor Portfolio series, and the second deep dive into Michael Burry's portfolio holdings. So if you haven't yet, consider subscribing to stay in the loop for future portfolio breakdowns. Now, let's dive into Burry's holdings and what they reveal about how he sees the stock market right now. Canada Goose Holdings, known for its luxury winter jackets, is a new position making up just 0.3% of Burry's portfolio. His second smallest position is in American Coastal Insurance. It's a Florida-based insurance provider that takes up around 2.5% of Burry's portfolio, and Burry increased his position in this company by around 50%. OSCR Health, a tech-driven health insurer aiming to modernize the space, is also a new buy and takes up around 3.5% of his portfolio. Another new buy is Magnera Corp. Magnera Corporation manufactures non-woven products used in healthcare, personal care, and hygiene markets globally. VF Corp, who owns brands like Vans, The North Face, and Timberland, is another new position taking up over 5% of Burry's portfolio. The manufacturer of scientific instruments for labs and healthcare, Bruker Corp, is another new addition to Burry's portfolio and takes up around 5.5%. HCA Healthcare, another new buy taking up almost 6% of Burry's portfolio, is one of the largest hospital operators in the US. Another new position with over 9% allocation is Pinduoduo, a fast-growing Chinese e-commerce platform known for group buying and low prices. Michael Burry reduced his position in Molina Healthcare by almost 17%. However, the provider of government-backed healthcare insurance still takes up 9.4% of his portfolio. With almost 10% allocation, Estee Lauder, a global powerhouse in cosmetics and skincare, is another new stock in Burry's portfolio. Burry also reduced his share in the logistics-heavy Chinese e-commerce giant JD.com. However, it still makes up over 13% of his portfolio. Baidu, the Chinese search engine leader and the strong player in AI and cloud tech, has remained unchanged and takes up 13.6% of his portfolio. And finally, Alibaba. With 16.4% allocation, Baba is still Burry's largest holding, even after a 25% reduction. The Chinese tech and commerce giant continues to lead the portfolio. Looking at the full portfolio, it's clear that Burry's holdings are fairly diverse. But one theme still stands out: China. Even though Burry trimmed his positions in Alibaba and JD.com, Chinese stocks still dominate the top of the portfolio. And with a new buy in Pinduoduo, it's clear Burry is still seeing potential in the region. Now let's dig deeper into the 8 new positions he added this quarter. We'll try to understand his thinking from the financial side and maybe uncover a few interesting ideas along the way. Let's start with Michael Burry's smallest new position. Canada Goose Holdings, originally known for functional cold weather gear, the company successfully rebranded itself as a premium brand with high prices, exclusivity, celebrity endorsements, and strong brand recognition. Canada Goose Holdings is trading around $8 per share. And as we can see, the company has been struggling for the last 3 years as it's down almost 70%. Looking at their financials, the company has around $800 million market cap, with an enterprise value of close to $1.2 billion. Their net debt to EBITDA ratio is just under 2, which is a fairly normal debt ratio, so no red flags here. The company has a decent almost 11% return on invested capital, and it is trading at 16 price-to-earnings ratio with a forward PE of less than 12. Looking at their revenue, we see that they have great revenue growth, more than quadrupling their revenue since 2016. They also have great and consistently growing profit margins, which we like to see. How about their net income? Looking at their net income, it is sustained, but they are struggling to reach their highs from 2019. Over the last few years, the company has also started buying back their shares fairly aggressively. Another metric we really like to see, as they are increasing your share of the company. Finally, let's do a quick look at what analysts are estimating for the company. For revenue, analysts expect fairly modest but still growth. However, when we look at their net income, analysts expect for it to almost double in the next 4 years. There isn't much to criticize here. Canada Goose has stable revenue growth, decent debt levels, and strong return on invested capital. The one area for improvement could be profitability. If the company can stabilize this, we could easily see strong returns in the near future. Next up is OSCR Health, a tech-driven health insurer that is focusing on making healthcare more affordable and user-friendly. OSCR Health is currently trading at around $13. It's a fairly new company, and over the last 3 years the company is up almost 40%. However, if we look at the last year, the company has been struggling, going back and forth between $14 and $23. The company has around $3.3 billion in market cap. However, their enterprise value is $2.2 billion, which means the company has around $1 billion, which is a third of their market cap, in cash and cash equivalent. It's really hard to go bankrupt when you have so much cash. I'm not the biggest fan of their return on invested capital. However, since it's an insurance company, I'm not sure if this is the best metric for it. Their PE ratio is 133. That's fairly hefty. However, their forward PE is only 18. Now let's go to their detailed financials. Since 2019, the company grew their revenue by almost 20 times. This is nothing short but amazing. When it comes to net income, 2024 was the first year they became profitable. However, we do see a positive trend over the last 2 years. Also, if they continue to grow their revenue on such a rapid pace, net income should follow. Let's look at the estimates. When it comes to revenue, analysts predict decent growth, growing from $9 billion last year to $13.5 billion in 2027. However, I'm more curious what analysts think about their profitability. And oh boy, does this look amazing. Analysts predict that in 2027, the company will make $570 million. If this would come true, in just 3 years, the company would be trading at around 6 price-to-earnings ratio. If we would remove the $1 billion they have in cash from their market cap, in 3 years, the company would be trading at closer to 4 PE. Honestly, if the analysts are right and OSCR Health can scale their profitability at the rate they're predicting, this would be a fantastic opportunity. A multi-bagger if I've ever seen one. The next step is to dive deeper into the assumptions behind these growth estimates and see if they can hold up, because if they can, this would be a great opportunity to invest. Magnera Corporation manufactures non-woven products used in healthcare, personal care, and hygiene markets globally. They produce items like baby diapers, medical garments, wipes, face masks, and filtration materials. Magnera Corporation, a really new company with just few months of public data, is currently trading at $18. The company is trading at around $600 million in market cap. However, their enterprise value is $2.5 billion, showing that they have around $1.8 billion in debt. The company is not profitable yet, however, they do expect profitability in the next 12 months. Over the last 3 years, it seems like their revenues have consistently been shrinking. It seems like the company used to be profitable. However, over the last 4 years, their profitability has been going down fairly heavily. Analysts expect their revenue to grow at a fairly slow pace over the next 5 years. And for profitability, they do assume that the company will become profitable, however, there's only data for the next 2 years. Looking at these financials, I can honestly say that this is a strange one. I am not sure what Burry sees in Magnera. The company's revenue is shrinking, it is carrying significant debt, and there's no expected fast future growth. This one stands out as a bit of a mystery, and one that I would skip with no big hesitation. The next position is one that I personally hold, and it's VF Corp. They own iconic brands like the North Face, Vans, and Timberland. I started this position simply as a turnaround play. VF Corp is currently trading at close to $16. And as you can see, the company has seen better times, as it is down close to 70% over the last 5 years. The company's market cap is $6 billion, and they have fairly high debt with net debt to EBITDA ratio of 3.13. This is not terrible, however, we would prefer it to be at least under 3. They have an okay return on invested capital at 7.4%. And as you can see, the company wasn't profitable over the last 12 months. However, they are expected for a turnaround in the next 12. Looking at their detailed financials, we see that their revenue has been fairly flat over the last 8 years. And when it comes to net income, we see that the past 2 years were fairly bad for the company, even losing almost $1 billion last year. Also, it seems like the company has been buying back shares fairly aggressively over the last few years. Analysts expect the company's revenue to slowly grow over the next 5 years. And when it comes to net income, we can see that analysts expect that their profitability will turn around and have decent growth over the next 5 years. This is exactly why I invested in this company. It is a potential turnaround play. If VF Corp can return to similar profit margins in the next few years, I see it as a strong candidate for doubling or even tripling its value. With allocation of over 5%, Bruker Corp is a scientific instruments company. Specializing in advanced technology, they provide high-performance analytical solutions for industries like pharmaceuticals, biotechnology, and academia. Bruker Corp is currently trading at around $42, and it is down over 55% in the last year. Its market cap is around $6 billion, with around $2 billion in debt. They have a decent 9.8 return on invested capital, and the company's current PE ratio is 55. However, their forward PE ratio is just 15. Looking at their revenue, we see stability in the growth of their revenue. In 2016, they did $1.6 billion, and last year they did $3.3. For net income, it seems like they have been doing the same thing, apart of the hiccup last year, where their net income dropped significantly. They also have been buying back shares over the last few years, which is nice to see. Looking at their net income predictions, it seems like the analysts are predicting similar, stable, mid-single digits growth over the next 5 years. And for net income, their predictions are even better. They're expecting their net income to double in the next few years. Bruker Corp shows solid and steady growth. And if analyst predictions hold true, at its current valuation, the company could be trading at a PE ratio of 9 in around 5 years. So at its current valuation, it seems like a solid bet for steady returns. HCA Healthcare is one of the largest for-profit hospital networks in the US. It has hundreds of hospitals and care facilities. They provide a wide range of medical services, from emergency care to specialized treatments. It's a new position in Burry's portfolio with nearly 6% portfolio allocation. HCA Healthcare is currently trading at around $340. It is down a bit from its all-time high of $415. However, if we look at a longer trend, we can see fairly stable growth over the last 5 years. They have $84 billion in market cap, and they have moderate debt with a 2.9 net debt to EBITDA ratio. They also have this beautiful 23% return on invested capital, showcasing their great ability to make money on their investments. The company is trading at a normal 15 PE ratio with a forward PE that's around 14. Since 2016, the company grew their revenue from $41 billion to more than $70. Truly beautiful and stable growth. In the same time period, they also managed to double their income. Looking at what analysts are predicting, it seems like they see the same stable growth in their revenue for the next 5 years. And analysts also see similar stable growth in their net income. Similar to Bruker Corp, HCA offers slow, steady growth and also an impressive return on invested capital. From the first glance, if you're looking for stability in your portfolio, HCA Healthcare could be a solid pick. Pinduoduo is a rapidly growing Chinese e-commerce platform. They focus on group buying to offer discounts on a variety of products. It thrives on social commerce, encouraging users to shop together for better deals. And Burry trusted the company with almost 10% of his portfolio. Pinduoduo is currently trading at around $120. And as most Chinese companies, it has been seeing a lot of fluctuation over the last few months. However, if we look at the 3-year graph, we see that the company has grown almost 200%. The company is trading at a $167 billion market cap. And they have more cash on hand than they have debt. They also have this amazing 33% return on invested capital, and they're trading at just 11 PE with a forward PE ratio of less than 10. So far, everything looks beautiful. Their revenue growth is simply amazing. In 2017, they did $268 million in revenue, and they grew that to $54 billion last year. Looking at their net income, for the first few years, they weren't profitable. However, they have been rapidly growing their profitability and reached over $15 billion last year. Analysts predict that the company will continue to grow its revenue and almost double in the next 5 years. For net income, analysts also predict good growth, but there is a slowdown in the last 3 years. Pinduoduo appears to be a remarkable company with explosive growth potential. Its business model has tremendous potential, and it's certainly a company to watch closely, as if they can continue to grow at the pace analysts are expecting, Pinduoduo could easily be another multi-bagger. The final new position in Burry's portfolio is Estee Lauder. It's a global leader in luxury beauty products, including skincare, makeup, fragrance, and hair care. Known for its high-quality offerings, the company is another new addition to Burry's portfolio. Estee Lauder is currently trading at $65, and the stock price has been crushed by the market for the last 3 years, as it is down more than 75%. The company is trading at $23 billion in market cap, and they have normal net debt to EBITDA ratio of 2.2, with a decent return on invested capital of 11%. For the last 12 months, the company wasn't profitable. However, it's expected to make a turnaround in the next 12. Their revenue has been stably growing since 2016, however, it started to shrink over the last 2 years. And their net income has been shrinking for the last 3 years. Analysts expect their revenue to shrink this year as well. However, they do see it starting to grow in the next 4. Looking at their net income, we see a really similar picture. Another shrinking this year and growth for the next 4. From this brief overview, it seems like Estee Lauder mirrors Burry's bet on VF Corp. It seems like it could be another turnaround play. Recently, Estee Lauder has faced struggles, but if a company can return to normal profitability levels, the stock could see significant upside. After reviewing all of Burry's new positions, one thing is clear, he has found a lot of great opportunities, many of which I personally liked and will have to dig deeper in. The only pick that left me scratching my head was Magnera Corporation. If any of you have insights into why Burry might have taken this position, let me know in the comments. I would love to hear your thoughts. But what stands out to me about his new buys is that they strike a balance between concentration and diversification. On one hand, his portfolio remains focused, with heavy weightings in a few key sectors. On the other, his new positions offer a mix of high-growth plays like Pinduoduo or OSCR Health. Additionally, they offer stable and reliable companies like HCA Healthcare and Burker Corp. And finally, turnaround opportunities like VF Corp and Estee Lauder. Honestly, his new holdings look like a great starter portfolio, covering different investment styles while maintaining a strong value-oriented approach. If I would have to pick, the two most interesting stocks for me were the two high-growth plays, Pinduoduo and OSCR Health. If these two perform anywhere close to what analysts are predicting, they could turn out to be amazing investments in the near future. I'll definitely be doing deeper dives into these two, as I want to see if they truly have that kind of potential. That said, almost every company Burry bought over the last quarter was really interesting to me. And if it was interesting to you, I would highly urge you not to blindly buy those companies just from my insights. I would suggest you to do a deeper dive and understand the companies better to make sure if they are a good fit to your portfolio. So what do you think about Burry's portfolio? Are you as excited as I am? Leave your thoughts in the comment section down below. If you enjoyed the video, consider helping my channel by clicking the like and subscribe buttons. And as always, guys, thank you for watching, and I hope to see you in the next one. Bye.